talk about consumption trends. It has been a strong performance that we've started to see. Revenge dining really is a thing, and we're seeing that in the QSR space as well. So, you've seen the strong growth. The question now is that how are you going to keep it sustainable? The 2020 World Cup, the benefits of all of that will also be, ending come Sunday. How sustainable is this performance?
Sure. So I would kind of attribute this to our omni-channel approach, and we're very happy and encouraged to see it playing out the way we had envisioned it. While I definitely agree there was a low base last year, same quarter because of COVID, but the year before that, which was FY20, we witnessed a strong growth even over that, which was roughly around 44% growth, led primarily by both the off-premise and the on-premise business. And that's primarily because of our omni-channel approach. And that's ensuring that customers get the same experience across channels and are able to consume more of the brand.
So Akshay, morning. What is the outlook in terms of the strong growth continuing? Do you think that will be the course of action, given the fact that you have spoken of healthy consumption trends?
So, the strong growth that we've seen in this quarter has been backed by three very strong pillars that we've been working on for quite a while now. They revolve around brand strategy, menu innovation led by our meal strategy. So both of them have ensured that we have a very strong brand relevance as well as a very good product market fit. The second one is our omni-channel approach, which we covered earlier. And that's allowed us to, have customers use us more because they get the same experience through a multi-channel and multi-day part approach. And lastly, because of volume growth due to these first two ones, we're seeing very healthy store expansion where new stores are doing better than anticipated. And, we are kind of doubling down on this lever. What we've seen in Q2 and Q1 is encouraging. We are seeing trends continue as we're going into Q3. So we are hoping and fingers crossed for a good quarter.
Now, your gross margins have managed to inch back to higher than what they were from the pre-COVID levels. What is the trajectory going forward in terms of your gross margins? Do you think you'll need to undertake price hikes, or are you likely to absorb the commodity pressure?
Sure. So, we actually look at gross margins over a period of time. And if you look at our trajectory pre-COVID, we delivered consistent improvement in gross margin. And actually how we do this is by relying on three levers that we use to manage gross margin. One is our pricing strategy. I think we've been very smart in the way we've taken pricing. It's both a science as well as an art for us. Firstly, we ensure that, it doesn't affect consumer demand as well as volume. But at the same time, it aids margins with the high food inflation that we see. Secondly, we also work on, supply chain optimization, cost optimization. And lastly, our product mix. Our product mix plays extremely strong because we have a wide variety and a diverse portfolio of products, including mid-cafe beverages, our fountain beverages, our premium burgers. And as a result of that, we've shown consistent improvement in gross margin. And like you rightly mentioned, this quarter was our highest so far. We definitely want to work on consistently improving the same. But for us, what's most important is our operating margin, where we also deliver our highest ever operating profits for the quarter.
Right. Akshay, the average annualized sales per store, which stands at about 67.5 million rupees in the second quarter. Previously, you had talked about maintaining it at 60 to 65. Will you then be upping the number?
Sure. So, we're looking at the normalized level within these parameters of say around 65 to 67 million AUV per store. We're definitely, continuing to build on volume since that's our main parameter internally also that we're measuring ourselves on. McDonald's business model is centered around volumes, and average unit volume is something that we want to consistently improve on year, which is why, we open the portfolio of stores that we do, which is why we have a multi-day part, multi-category strategy, as well as a multi-channel strategy. And as a result of that, we're able to push volumes. And with that comes the operating leverage, that I was talking about.
Right. Also, actually, the store addition in the first half of the fiscal is only about 10 to 11 stores. You have expectation of 35 to 40 stores by the end of the fiscal. Is that on track, or is there any change in the store addition plan?
Sure. So that's correct. Actually, you will see more store additions in the second half of the year. Actually, both traditionally as well as historically, McDonald's cycle in real estate is a little longer because we, focus very heavily on the quality of our locations, the tenure, the store portfolio that we have, with a focus on drive-throughs as well. So our cycle time is a little longer, and what you do see is in half two, we traditionally and historically 35 to 40 stores that we've spoken about in FY23.
So, what about store openings? Will the focus now be then on tier 3 and 4 cities?
Sure. So, we will continue to have a strong focus on our key cities, especially in the south, where, we have a larger penetration opportunity. Our brand relevance and product market fit there has also become extremely strong and is driving these unit volume sales. However, we will increase our focus on these smaller towns as well. So you will see, more of a focus on these smaller towns while we continue to build our strength in these key cities.